Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar being brought to us by Lyons Wealth Management. We're very pleased to have with us today Sonder Reed, who is the CEO of Lyons Wealth Management, which is a registered investment advisor that serves as an asset manager to a broad range of clients and investment professionals. Their mission is to create unique investment solutions that help their clients meet long-term goals. So with that, please join me in welcoming, let me go ahead, put Sonder's information up on the screen. And Sonder, now if you could simply double click and let's get underway here today. Thanks so much for joining us, Sonder. Take it away.
Okay, thanks, Cynthia. Can you see my screen okay?
It looks great.
Okay, great.
We see it in
Thanks
full
so much.
view.
Okay, excellent. Well, hello, everyone. Happy Friday. I hope everyone's staying healthy with this crazy COVID times. Little background on me and the firm. It got started back in 1993 at Merrill Lynch, and then really went fully independent back in 1998. So I've been independent for quite a while. Basically, the point of today's tactical investing webinar is to really go through the differentiation of us and other tactical managers. It's been a space that went from zero to about 100 billion after the crash of 2008, 2009. Basically, no one had heard of tactical. It's mistaken for market timing by a lot of folks, but there's different ways to approach tactical investing. So one of the main reasons, the story behind why we got into tactical investing is because one of our other claims to fame as a firm, Lyons Wealth, is we help clients with large concentrated stock positions. So you'll have someone with, one to billions of dollars worth of stock, whatever it may be, the CEO of a company, and a lot of times the client doesn't want to sell the stock. And we have developed a specialty into that area. And unfortunately for us and some of our clients, one of our biggest positions going into 2008, 2009 was Citigroup. And you may recall, if you were in the business or managing your money in 2008, 2009, Citigroup went from 60 to 40 to 20. We encouraged a lot of our customers to hedge at that point, which would be, for instance, a cashless collar. A lot of these guys knew the CEO and whatnot and said the stock's going back to 35. So a lot of single stock position people carry debt. So unfortunately, when the stock went from 20 to 75 cents, they were pretty much wiped out, and it's a horrible story. And as we came out of the carnage of 2008, 2009, I've also managed money during 2000 to 2003 crash, trails of tears, retirement plans destroyed. So it's a horrible time. And I said to my crew and my team, let's figure out a way to give our clients a chance to get out of the next market crash, because we don't want to go through this ever again. And we don't want our clients to ever go through this again. And one of the things I used to jokingly say is, I don't care if you get a monkey in the basement that has a way to get us out of the next market crash. If he can do it, or I'm interested. So with that, we searched, we got a little bit lucky. We searched around a little bit and were introduced to a small tactical manager called Good Harbor. And Good Harbor had sidestepped with real track record and real money. They sidestepped the crash of 2008 and 2009. They were up 8 in 2000. Up 2 in 2008 and up 49% in 2009. I'm getting my numbers confused here. So they missed the market crash. And so we brought them in as our sub-advisor, and it's kind of like the analogy of no one wants hurricane insurance until after the hurricane hits. When we started showing them having missed the market crash, we were raising $25 million a week into their program. We raised about $1 billion. They went to 11 billion, and we really learned the language of tactical by representing them to advisors all across the United States. We eventually wanted to part ways mutually in 2012. So we sold those assets and our sales force over to the Good Harbor guys, and they continued on without us. And we then launched our own version of tactical. So one of the characteristics of a typical tactical manager is that they sector rotate using ETFs. So they'll be getting in and out of the market on a monthly basis, 50-50, leverage in some cases. And we thought there's a better way to do it. And also, a lot of the advisors we dealt with were Wells guys. And there was a program at Wells called DSIP, which is a dividend investment program. It's sort of like a menu of what they considered pretty safe stocks that they could build portfolios without having to go to the manager every time to get approval. So the Wells advisors really loved the idea of being in non-leveraged stock as opposed to ETFs and sector rotation. And they also like the idea of a much slower moving tactical trigger, which is basically one of the major differentiators of us and everyone else. So but that's where it comes from. There's no such thing as a perfect signal. There's going to be situations where we get it wrong. I think if you, and I think we had a Stanford guy, a Harvard guy, a UCF guy, and me, and a couple other people working on this model. The best, if you have a model that's right 6 or 7 out of 10 times, you've got an incredible model. So you got to assume sometimes we're going to have a false signal, and we actually will get into that as well, because we've figured out a way to mitigate that situation also. So, but let's get into the nitty gritty of tactical investing here a little bit. Obviously, you want to read this disclosure at your leisure, and we can do that. So when you have time, obviously, all markets can crash, etc. S&P can go to zero, right? Possibly. So generally speaking, I'm going to read a little bit. I'm not a huge fan of doing PowerPoint, just reading along, but this is pretty good. Tactical managers attempt to miss the equity market declines by rotating through asset classes or market sectors, while others short stocks to make an effort to hedge. I think shorting is one of the most complicated, difficult things to do in the stock market ever. It's a rare talent that very few people have. I think the solution we came up with, I jokingly call it the poor man's version of shorting, but actually I think it's the smarter, wealthier man's version of shorting, just because shorting's so difficult. But again, ETF rotation and doing that month in and month out, it's really looking for a needle in a haystack. So we designed our program to not do that. But that's when someone says, it's kind of like, how do you define a chocolate chip cookie? It's a cookie with chocolate chips in it. Tactical is generally defined as sector rotation through ETFs in very short changes. And last but not least, with our wealthy clients in California and New York, if you're constantly handing out short-term capital gains, you're basically 50% of your profits are going to the government every year. So we aren't allowed to advertise our program as a tax advantage program. But because we sector rotate, or we stock select on a quarterly basis, not sector rotate. Basically, we give our clients a chance to have long-term capital gains. And over the 7, now almost 8 years of managing portfolios, we've been able to keep about 2/3 of the portfolio long-term capital gains. So we're also probably one of the only tax-efficient tactical managers on the planet. So let's see here. Let's go to the next slide. So here's sort of the philosophy behind it as well. The markets have constant brief declines, 5 and 10%. Bear markets are a whole different animal. Literally, they are the big whopper crashes. And the thing about bear markets is you look at an average, like the average is down 30, the average is down 50, or whatever it may be. But like I just said earlier, you can have those Citibanks and other things just bleed on you. So diversification is important, and getting out of harm's way is important. Everybody pretty much knows the power of compounding. So, if you lose 50%, you have to make 100% to recover it. And a lot of times, that's years of recovery. And, if you imagine someone retiring in 2000 at 65, let's say, the market really didn't go positive till 2014. So you're 74 years old before the market starts getting positive. And that's a long time frame to not make money, especially if that's when you're retiring. Wait, 65 and it'd be 79. Sorry, if you wait 14 years for the recovery from that. So, and then if you study 11 bear markets have occurred since 1950, which is every 6 years. What's kind of amazing, good or bad, is that we just went through the longest bull market in history. It was 11 years. And so you'd say, well, and a lot of people have said the last few years, well, why would I need a tactical manager? I can just get long the S&P 500 for free. And that's true. This has been, I hate to call it dumb money, but this has been the best era I've ever seen for index performance. And God bless the S&P 500 and anyone that owned it, and FANGs. I just don't think the next 5 years or even 10 are going to be like that. It's pretty rare for a market to remain and to have the same characteristic, decades at a time. So I think we just had an amazing 10 or 11 year run. We can see just from what's happened in the last 6 months and really the last 18 months. I mean, the market was really volatile at the end of 18, as you probably recall. Christmas Eve in December of 18, market was severely down. And I'll get into our risk indicator later, but it's momentum based. So momentum's going to take us out of the market and it's going to take us into the market. So that's the concept of time. I almost like to show this graph just because so many people seem to have forgotten what the market crashes felt like. But there you have it. So to make a long story short, our program is not designed to keep you out of those black cuts to the downside, right? Our program is designed, and its goal is to miss the big crash, big red crashes there. And like I said, no guarantees that we believe we have an excellent signal, and I think it's going to work the majority of the time, but we're not always going to catch it perfectly. So, and the other thing is, I think if you talk to traders, they'll all tell you that they may have hit the high of a market, and they may have hit a low of a market once or twice in their careers, but because this trigger is relatively slow moving, we're not going to catch the tops and bottoms. So you'll have people that are disappointed if we get directional one way or the other, whether it's a bull market or a bear market. You'll have people that question the signal, and we can get into studies of some of the misses and some of the wins we've had by being early or late, based on historical back-tested type information. And then we also have some real live data, which is not on this particular webinar, but we can certainly get into it offline if any of you are interested. And again, an ugly reminder here, this is your max drawdown for the S&P, 56.78%. So imagine you have a $10 million portfolio in the market and it's worth less than $5 million in the trough. That's a game changer for any investor. And so again, we want to do our very best to give our clients a chance to sidestep those market crashes. And a lot of the underperformance of our peers comes from trying to catch all these little moves, all these little cuts in the market, because that's kind of the nature of the market. It has the 5, 10, 15% drawdowns that has a tendency to recover. Those aren't really bear markets. So again, getting back to when we're long the market, which is, so from a historical backtesting point of view, 70% of the time we're in the market and 30% of the time we're out of the market. This last 7 years of live data, the majority of the time we've been in this market, which has been fantastic for our clients. But if you're in the market, we believe that you can outperform indexes. It's been very difficult the last 5 years, as I mentioned. But our stock picking philosophy is that you don't need hundreds of stocks. We believe in a concentrated portfolio. We believe in basically the two major components of our stock screen is return on invested capital and value. So we start a screen of dividend stocks generally over 1.5, and then we run. So return on invested capital basically is the example I use is, let's say you buy $1 million printer, or you buy $1 million saw for a lumber yard, and let's say the $1 million printer produces 100,000 of profit, and the saw produces 50,000 of profit. The return on invested capital is better for the printing company because it's making more return on the investment they made back in the business and the capital expenditure. And then we have a sort of a Buffett, Graham Dodd type value so that we don't pay too much for these high growth companies. That's good, bad. It's good in that we're going to own an Apple. It's bad that we're going to miss a Facebook and a Netflix. but we believe to tilt the portfolio more on the value side. So that's the stock screen. When we do our screen on a quarterly basis, that ranking system spits out 250 stocks, and we pick from roughly the top 50. And it's model driven, because I try to remind people that we try to take a lot of the emotions out of the investment process by making it model driven. But obviously, if you've got a United Airlines and a Delta in the top 25 stocks, we've got to make a decision on whether we're going to own one or the other, because we don't want two airline stocks. So we'll research those companies. I mean, we pretty much research every company in the mix anyway, but we'll make human decisions, measure 3 times, cut once, to have those portfolios on a quarterly basis. And like I said, we generally believe in the stocks that the model selects, and we research them. So a lot of times they'll move around the ranking. It may be number 1 one quarter, number 20 the next quarter. But what's nice is a lot of them stay in the higher levels of the ranking. So then we give our clients a chance to get, long-term capital gains, which is pretty much unheard of in the tactical space in general. So that's kind of the methodology there. And the thing is, markets usually don't crash. Markets are generally pretty boring. So if we can give our clients some alpha in our stock selection process, and we get some outperformance out of the S&P 500, we'll take it. And we believe that in the long run, that's a great methodology to get great performance. The FANG stocks kind of left everyone in the dust the last 5 years. So, and we're not FANG investors, but everything cycles. So if there's a value cycle or a cycle that favors our type of stock selection, I think we'll have a lot of outperformance compared to the indexes. Let's see. I just flipped the screen a little too fast there. So again, offense first. Most of the times markets don't crash. We apply the risk indicator, which I'll get into in a little while. So it's offense first, defense second. So we're long the market the whole time. We stayed invested from 2012 to basically 2019, and then we had a couple shifts that I'll get into later. But most of the time markets don't crash, and we're going to stay long, and that's what differentiates us from so many of the other guys. And then we go with stocks versus indexes and ETFs. We do not leverage, and we don't short. And the defense is focused on momentum, and we developed the quantitative risk indicator, which is our signal to get out. And again, I'll get into that in a minute here. So this is a bit redundant, so I'm going to skip through it, save you guys the time a little bit. And then this is the method of the madness as far as constructing the portfolio. So we have our 25 to 30 stocks. People ask, do you make a mid-month decision on exiting the market? And the answer is no, because one of our economic models, confirming indicators, is consumer sentiment. We don't get that number to the end of the month. Plus the mathematical equations of our signal also give us sort of month-end numbers. So the exit or remaining fully invested decision is always at the end of the month, and not in the middle of the month. So that's important to know. And again, as I mentioned, we rebalance on a quarterly basis. And then this gets into the risk indicator. So the risk indicator, the quantitative risk indicator, we looked at a whole bunch of different models and back testing, and this is a momentum-based model of 3 different time frames. It's short, intermediate, and long, and it's rate of change. So if you think of a stoplight, when all 3 of our momentum indicators go from green to red, all 3 of them roll over, and we have a down-sloping consumer sentiment number, we are going to exit the market. And when we exit the market, that means we sell all the stock positions and we buy treasuries first. We can go to cash, but we definitely go to treasuries, and that's kind of that poor man's short, which I'll get into in a few minutes. So to understand the big picture of the signal, it's momentum. So good news, bad news. If a market's rolling over or sideways for a long period of time, and then it really rolls over, that's an environment that will get us out. If you think of what the market looked like as it grinded through the end of 2017 into 18, a lot of momentum had come down, and then you had sort of a accumulation of selling at the end of 18, which gave us a signal to get out. and we shifted to Treasuries, which you'd say, well, that was a horrible move because then the market skyrocketed back. We added Whipsaw insurance to our program sort of in the middle of last year, and I'll get into that a little more. But the bottom line is it's not a bad thing to follow momentum, because usually momentum leads you to a bear market or to a bull market. It's price and momentum. So we have to hang our hat on that model. And then you had a lot of momentum here this spring with the COVID situation, downward pressure. So all sorts of things can happen, but it's based on momentum and consumer sentiment as far as our signal goes. It is proprietary. We don't sort of reveal our secret the way Coca-Cola doesn't tell you what their formula is either. So we have a lot of people over the years asking what's the formula, and it's just not going to be disclosed. It's a proprietary property of Lyons Wealth. So we go to Treasuries from equities. This is a binary signal, very simple. And I'll get to the slides here in a second. This is a little outdated. This just shows you, we've been in this market long. It ends here, but this continues on for another couple of years. I'm more than happy to share what we look like from this date and beyond, offline, as far as that goes. And again, this is what the market's done, going through really, 5-6 years. The data continues the same up until 2019. And these are where, so what is Whipsaw? Whipsaw is, let's say you get out here at the bottom and then the market recovers and you're out. So you miss that recovery, then you get back in and then the market sells off, and then you get out again and then the market recovers. So a lot of tactical players burn up their rate of return by shifting out of the market too frequently. And you'll see here in a minute what they're looking for is a needle in the haystack, which is these 10 best days, 10 worst days. Because we did a study on that, and we found that the 10 best days and the 10 worst days, and this is sort of an old Wall Street, imagine your return if you miss the 10 worst days. Trying to miss those days is finding a needle in a haystack, and almost all the best days and worst days happen during bear markets. So if our philosophy is to miss the bear markets, you're gonna alleviate the majority of those best days, worst days. So this is an example. Here is a graph of your 10 best days, 10 worst days, and you can see, other than this outlier here in 2011, which back tested wise, we wouldn't have gotten out. This basically is the only day outside of the market crash of 08-09. So that's really the major differentiator between us and so many other tactical managers, is that they're looking for this, and it creates a lot of whipsaw, which generally is bad for performance. And again, we're not too worried about missing little market declines, but we do want to stay out of harm's way when it comes to the big bear markets. And again, this is a closer look. This is the market crash of 2000 to 2003, and you can see this is where our back-tested indicator would. So in other words, we were not managing real money back then, but our back-tested indicator here would have gotten you out of the majority of these best days and worst days. So that would have been good to miss in those days. And then this is what that performance would look like. So most Treasuries, I think the average is 12%. So here's the explanation of the poor man's short. If the market's crashing, there's generally a flight to quality, and that flight to quality is Treasuries. So it's the U.S. government bonds. We keep it 10 years or less, and it's a blended portfolio of Treasuries. Those generally go up because money piles into those bonds for safety. And what does that mean? So let's say the Treasuries are yielding 3 and at 100, but everyone piles into them. It might go from 100 to 110. So there's your 10% rate of return. And then the yield drops to 1, but that's where safe money goes. So we're looking to make money when everyone else is losing. And that's exactly what happened from a backtested point of view in 2000. And then this is what 2009 would look like. So like Treasuries made money in 2019, which is a little unusual. So we can even make money in Treasuries in a bull market. But it is our defensive signal. It's where money goes when we get defensive. We can also apply the risk indicator to the Treasuries and exit the Treasuries if they're behaving in a negative way. But my guess is 99% of the time, we're going to be in Treasuries and stay in Treasuries during our defensive shifts. And there's something to be said for whether it's us or any other tactical manager. It's kind of nice to be sitting out when the market's crashing. It's a good feeling, and I think it's something that more people would like to have going forward if we get more volatility in the market. And then let's see here, more disclosure here. That's me, and this is our information. Let's see here. Let me go up one. We'll I think by signing up for this webinar, we're able to reach out to you to a certain extent. So we can send you more updated information as far as what we've done the last couple of years. So let me just talk a little bit about Whipsaw Insurance, then we'll get to some questions. So when we got out of the market, so imagine we have this horrific Christmas Eve, 2018, market's finally going to roll over, everyone's negative, our momentum pulls us out of the market, we go long Treasuries. So we ended up making, it depends on the program, 3 to 5% in 2019, while market went up 30. So compared to the S&P 500, we looked horrible. And the momentum was so strong that it actually got us back in the market in late January, early February this year. But what's the point of being an active manager if you don't learn as you move through time? So I thought to myself, if I could have done one thing differently to make this program better, I would add a long call option when we exit the market, and I'd add a long put option if we enter the market. So basically, when we got it, we can kind of anticipate signals coming just by looking at what the moving averages are doing in our target numbers, knowing probably that we were going to get back in the market at the end of January. We got options approval in our mutual fund. We got options approval for the majority of our clients. Some folks didn't get their paperwork back in time, but basically we bought put options in both our fund and in the separately managed account Lyons Tactical Allocation portfolio, and there's 6 to 9 month put options or call options if it's the other direction. And the idea is that if you're wrong, if our signal is wrong, the market's probably going to move pretty dramatically in the other direction, and we don't want our clients to get whipsawed, even though these signals take, in some cases, decades to fire. So we got back in the market, if you can imagine, February 1st, but we also bought protected puts. So, and those put values exploded in value because of the volatility that came from COVID. So especially in the SMA with the folks that had the proper options approval, we actually made money through that decline because the options, the value of the options went up so much. We had to sort of stair step into the option strategy in the mutual fund, so the performance is a bit different. We just couldn't get it all done day one, the way we trade the mutual fund as opposed to the SMA. So there's a little bit of a divergence in performance there, but the bottom line is we picked up a ton of alpha, putting our hedge on, which is long puts, like I said. And then when the market seemed to hit a bottom, it also had was a 3 to 6 month time frame. We exited the majority of those positions. We rolled a few out, but especially in the SMA, I think it was somewhere around 20% alpha to the S&P, which made our clients very happy. And then we rebalanced, and we were able to average into some of the beaten up stocks that were in our, like Marriott and Darden, and those came roaring back. So we protected against the downside move, and we caught that upside recovery. So tactical really paid off for the first time in a long time, and we're really happy about it. So if you can imagine going forward, we're long equity. If let's just say the market rolls over and a risk indicator gets us out, we'll exit the market, but we'll buy calls. Meaning, if the market goes down, then we'll be in Treasuries and we'll spend 2 or 3% on the calls. And we come up with 2 or 3% because the cumulative return on both the programs was over 100% since inception. We felt like spending 2 or 3% on defense was worth it, and it certainly paid off. But in the other direction, in the long direction, we'd buy calls and spend 2 or 3% and basically be indexed to the market, but be long Treasuries. So if the market sold off, we still have that chance of making, a 5 to 15% rate of return in a market crash. So it's exciting times. I think tactical should be a part of anyone's portfolio. If you've got S&P 500, you should add a portion of that percentage to our program. We're U.S. based, so we don't have ADRs, we don't have utilities, but we give you a look. Like I said, there's no such thing as a perfect signal. But if you have, let's say, 50% of your money in S&P 500, why not put 20% in our program? You're going to catch the majority of a bull market, but we're going to give you a chance to get out for one. And even if you use our signal for other programs, like if we get out of our program, you may want to consider getting out of small and mid cap as well. So it has a spot in everyone's portfolio. It's not international is my point here. So it's no ADRs, no utilities, and no financials. So you want to have a financial ETF if you believe in that. If you want to have utilities or any kind of ex-US type investments, we don't cover that with this portfolio. What you get is a large cap, return on invested capital, value type portfolio with the risk indicator. And when we get that signal and get defensive, it gives you, a look. You could say to yourself, well, I don't know if they're right or not, but Lyons got out of the market here. Better watch out. Or hey, Lyons got back in the market. So it's a nice signal to have as part of any portfolio. But I'm gonna let's go to some questions.
And as a quick reminder for everyone, there is a questions panel located over on the right-hand side of your screen. Simply double-click that questions title bar, and you can add any questions you have for Sandra at this point. Thanks. Back to you.
Mm-hmm. Thanks, Cynthia.
Well, I am going to come back and also mention that the slides that we've been using for today's presentation are available in the handout screen over on the right-hand side or included in the control panel as well. So if you'd like a copy, you can simply download that PDF directly from today's session. As a reminder, we have been recording today's event, and each of you will get a direct link to today's recorded playback soon after the session ends. So if you want to come back and review the concepts that Sandra was going through today, simply watch your inbox later on for that direct link. All right, Sandra, are you seeing any additional questions pop in?
I don't. I'm kind of surprised, but that's okay. I know I'm thorough, so that's good.
Well, that is. Well, with that, then, what we will do is conclude our session here today. I want to thank all of you for your presentation or for your participation, and thank Sandra Reed for his.
Cynthia.
I do see
Cynthia,
one came in.
No, okay. So Maged. Yeah. Okay. So thanks, Dan. By the way, let me literally slide back up to the slides here. If you're a grizzled veteran of Wall Street the way I am at this point, back in the 90s, a handful of studies came out basically saying if you miss the 10 best days of the stock market, your performance goes down by a certain percent. And then another study came out saying, well, if you miss the 10 best days, or the 10 worst days, whatever, the 10 best days, 10 worst days was an entire marketing spiel. That was given to people, which was basically saying you should just stay invested all the time, and that's the beginning of this whole index investing craze. I mean, trillions of. Here's what everyone should be worried about, and why you should consider tactical, whether it's us or anyone else. Trillions of dollars is in S&P now, and if people want out, it's a stampede. It's a tough trade to get out of. You can see how fast. I mean, the market went down something like 34% in 3 weeks. In March, that should scare everybody. But anyway, this graph right here, what I mean by the 10 best days and 10 worst days is if you see the green and the red, red or, let's say the market's down 800 points one day, and then the next day it's up 1,000 points, which also happened in March. They would use these statistics saying if you eliminated those 10 worst days, imagine what your rate of return, if you could just keep those positive days. But the problem is they all happen at the same time. So it basically alleviated the argument. And then for our philosophy, our tactical trigger is designed to not catch all these little market moves. We're only going to try to get people out of the big bear market crashes. And that gives us lots of running room for bull markets like we just had. And then it also, it kind of takes care of everything if we get out of the next bear market correctly. So that's the 10 best day, 10 worst day. What does the speaker answer there? I hope that helps, Maged. And if you want to email me or whatever, I'd be more than happy to get deeper into that dialogue with you. Okay, what is the speaker position regarding gold, silver investment in the tactical allocation? Well, I get the Bitcoin and I get the gold and silver questions. It's not my specialty. What is kind of interesting, and I would be willing to look at this. It takes us a little research, but we can apply the risk indicator to anything. So we can apply the risk indicator to stocks and bonds. We can apply it to gold and silver. I haven't done that in a long time. We've actually applied it to stocks here and there that we're interested in. Eileen, if you want to email me, we can plug in gold and see what it looks like, because we could have a signal for you to get in, signal to get out. It's not like a service we provide, but we can certainly intellectually bat it around with you if you'd like. Let's see. Am I offering capital guaranteed strategy? Maged, I suggest we talk offline. There's almost no guarantees on Wall Street. It's like the G word. It's like you don't want to say it because it's so risky. It's a compliance issue to say the word guarantee. That being said, there are funds called guarantee funds where you'll take 80 or 90% of a portfolio and invest it in bonds. So let's say the bonds are yielding 5 over 4 years, 80% becomes 100%. And then you take the 20% and you invest it in whatever you want to invest in, wild and crazy stuff. That's kind of how the old guaranteed programs worked. If you've got something specific, we can custom design something like that for you. We're very good option traders and whatnot. So I hope I'm saying it right, Maged. Let's meet offline on that. Okay, Kip, let's see. I have missed it, but could you discuss your management fee structure? Yeah, so we're pretty standard. It's the retail. So the minimum account size for the separately managed account is $100,000, and we charge 1.5%. Obviously, if you come in with a couple $1 million, we have breakpoints. I think over 1 million is 1.25%, and over 3 million it goes to 0.95. So we break it down. Certainly, more than happy to discuss that with you, depending on what the situation is. So hopefully that helps. As far as the fees go, yeah. So the minimum on the separately managed account is 100,000, and we charge 1.5% annually. So 1.5 pennies per dollar, right? Not too expensive, I don't think. And then it comes down to 1.25 over 1 million, and then 0.95 over 3 million. And I almost have to check my prospectus that those are the right grade points. But like I said, we're more than happy to discuss those fees, and if we can negotiate, that's fine too. Hope that helps there. Lion, I don't know if I'm even, our website's lyonswealth.com. We've got information over there. Our Form ADV is on there. And then I'm going to email everyone. Like I said, this data is a bit dated. It doesn't really matter because the concept's what's relevant, not the time frame. But we'll get you updated information on performance and everything else. So thanks for joining us, everyone, and have a great COVID-free. Oh wait, can an RA aggregate to hit breakpoints? Absolutely. Yep. Yeah, we can absolutely do that. And I just asked my contact at IB. We've been in and out of the IB marketplace on and off. I don't know, for some reason we're not in it right now, but I think we should be. So, but Scott, let's chat offline, and we can certainly work with you.
Well, Saunders, excellent presentation here today. I want to thank you, and I want to thank everyone for participating, and remind you to watch your email later on. We have been recording today's event, and we'll provide each of you with a recorded link to our recorded playback, as well as a copy of today's slides. So with that, we are going to conclude our session. Thanks, everyone. You can exit using the X in the upper right-hand corner of your screen. Have a great day, all, and thank you.
Thanks so much.